Good afternoon. This is Jeff Cockrell. I'm a partner with McGuireWoods in the Chicago office. I'm joined with Alexis Reynolds, an associate in our healthcare group, and Karan Garg from Houlihan Lokey. We're going to be talking a bit about a recap of kind of what happened in 2019 in the DSO market. It's been a wild ride for a decade. But the consolidation continues, a very active market, very ripe multiples, and a lot of interesting dynamics to that. But by way of a little bit of an introduction, I'm Jeff Cockrell. I'm the head of the private equity group at McGuireWoods. McGuireWoods is an international law firm with about 1,100 attorneys spread out across the country, where I head the private equity group with maybe 50 or 60 folks in my group. I sit at the intersection of private equity and healthcare, and almost all the transactions that I work on are healthcare provider services, of which dental services is a significant component of that. Alexis sits in our healthcare group, and I work with Alexis on a lot of different transactions, and we're really thrilled to be joined by Karan Garg from Houlihan Lokey, or KG to anybody who knows him. KG is probably one of the most distinguished investment bankers in healthcare in general and in dental markets in particular. He touches lots and lots of transactions in the DSO market, and we're really thrilled to have him joining us. But KG, maybe give a little bit of introduction of yourself as well.
Sure. Thank you, Jeff. So, Karan Garg, I go by KG. I work with Houlihan Lokey. Houlihan Lokey is a global investment bank. We've been around for 40-plus years, publicly traded on the NYSE. Offices across U.S., Europe, Asia, Australia, and the Middle East. 1,500 bankers across the globe. I sit in the healthcare group in the U.S., which is roughly about 45 people, and we are focused on middle market transactions, typically average size being somewhere in the $300 to $400 million range. I specifically focus a lot of my time in the dental sector. Have over the last 4 years completed north of 20 deals in the space with an aggregate enterprise value of roughly $5 billion. And as Jeff mentioned, this market continues to be very active. Dental is one of the largest markets in the U.S., roughly around $140 billion, with a lot of backing and investment from private equity funds as we continue to see consolidation and continued investment from PE groups.
So KG, to start us out, consolidation is obviously pulling together smaller organizations and making them into bigger ones. In theory, there's not an endless life cycle for consolidation in any industry. Dental has been going for 10, 15 years at a pretty brisk pace. Where do you see us in the consolidation life cycle in the DSO universe entirety?
Yeah, people have thrown out metrics and stats around this, but if you really look at, as I mentioned, a $140 billion market, which then further parses out into general dentistry, specialty dentistry, which may include pediatrics, orthodontics, endodontics, oral surgery, and then and what is happening within each of those specific markets. I still feel that we're in the early stages of consolidation. The top 10 DSOs account for less than 10% of the overall dental market. Only 8 to 10% of the dentists actually work for a DSO today, and which represent roughly between 15 and 20% of the overall market in the dental world. So there's still a ton of consolidation that needs to happen and will happen, given the benefits that DSOs bring to the table for these dentists and for the patients and for the payers on an overall basis.
Maybe starting the discussion a little bit on the top end of the market. The DSO market is more mature than some of the other sectors in healthcare, so there have grown to be a number of large regional platforms. And I guess the question is, setting aside the continued inflow of smaller practices, what does the investment thesis look like for some of those large regional practices and the folks that might be a buyer of those large regional practices?
Yeah, so I mean, just to take a few names, Heartland Dental is now 1,000 offices across the U.S. Pacific and Aspen both reached at the 800 mark this year as well. Historically, they have grown through Aspen, for example, in some ways Pacific as well. They have grown through Denovos for the most part. Heartland has a bit more of a bifurcated strategy, both around Denovos and acquisitions. But even when they're doing acquisitions or affiliations, as we like to call them in the DSO world, they've typically been smaller groups, 4 to 5 practices, or single office practices from doctors. At 1,000 offices or 800 offices, moving the needle with that level of activity is difficult. There are today close to 80 plus private equity backed, DSOs in the space of all sizes and shapes, small local markets to regional and multi-regional. And all of these guys have invested in these assets with the envisioning an exit in a certain time period. So there is a natural opportunity for the larger players in the market to consolidate some of these smaller players as they become larger and larger and it becomes more difficult for them to move the needle. So my prediction is that we'll see a lot more DSO to DSO transaction. The most recent one that I can talk about is the sale of Dental One Partners to Mid-Atlantic Dental. Mid-Atlantic Dental was roughly 60, 70 offices. And they decided, hey, rather than doing this over a 4 to 5 year period and doing 20 transactions a year, we're going to do one large transaction, acquire 150 offices, and then add value to those 150 offices, integrate them, and make it into a platform. So I continue to think that will continue to happen. We saw that with Affordable Care as well. They recently bought a business called DDS, which was a service line expansion for them. They got into the implant business, which is a core strategy for them. Again, it was a strategic to strategic transaction, which made a lot of sense for that platform.
And if you keep taking the next step, I can understand a large regional maybe combining with another one or acquiring kind of sub-regionals. Most of those owned larger regionals are still looking at selling to someone in the future, and then the question just gets kind of kicked down the road a little bit of what do the economics look like for that next buyer. And one of my thoughts is that when you get to a certain scale, the nature of the buyers also change. That if you're a middle market private equity fund, your IRR expectations are pretty high and pretty robust, and you can meet those by doing a whole series of smaller acquisitions. You get to a certain size, and the expectations might be different. That a large mega fund may have a little different IRR expectation since it's more stable business, or perhaps even public markets as a landing point. When you look down the next kind of turn of these large ones, where do you see those going?
Yeah, no, there's definitely a difference between return threshold for somebody that is a middle market private equity fund versus somebody who's a mega fund and what their expectations are, especially if they're looking to move the needle in a meaningful way. Some of these regional and multi-regional assets are not going to be at the same price as the onesie-twosies that people have been doing in the past. So that automatically changes your return threshold and your return expectation. There is a finite number of buyers in the market that can do a multi-billion-dollar transactions. With that said, the largest transaction that has happened in the space was $2.75 billion. If you were to look at other industries, it's still a very small fraction of what private equity funds have been able to do. So I can see this going in a couple different ways. We'll probably see more money coming in from pension funds or family offices, which have a longer threshold or time horizon. We can see club deals with private equity funds, and Aspen is a great example of that, where we have 3 different funds invested. And we can see more of that happening in the future. And then for, at least in the U.S., for DSOs that are not drawing funds from public sources like Medicaid, they have a better chance or have a better, more viable to go public and access the public markets. Because the consolidation opportunity still exists, the market will look at the white space and the track record of a business that has grown to $1 billion in revenue and will value it appropriately.
Maybe turning to the other end of the market, as far as strategies that are built on Denovo and acquisition of smaller practices, maybe starting with the Denovo, there's not an endless amount of green space for Denovos in different markets. Do you think that kind of the amount of Denovos that have occurred puts any limit on the ability to expand with that strategy?
Yeah, I don't really think of de novos and acquisition targets as two very separate growth avenues. At the end of the day, it's all about capturing market share. So the reason why you would acquire an affiliate with a doctor is because you see opportunity in that market, and you have a thesis saying if this office today is doing $2 million of revenue and $500,000 of EBITDA, on my platform, I can make it more efficient through better marketing, better supply, better lab pricing, better payer contracts, more efficient scheduling, all the productivity pieces that you can put in place, and take that $500,000 and $2 million to $2.5 and $750. The de novo is a very similar approach as well. You would only open a de novo where you saw the market opportunity, whether the demographics make sense based on your past strategy, whether the site location makes sense because of foot traffic, and you have a really solid marketing and advertising function which can generate the new business or the new patient volume to capture market share from other players in the market. So I don't really view that as either of those two things being constrained by where the market is. At the end of the day, the dental market is growing 3 to 5%, depending on what sector or what subsector you look at. People are trying to share or capture that growth. Now, the DSOs are growing at 15%. The reason is because they're taking share away from the solo practitioners, and that'll continue, whether it's through de novos or through affiliations. Now, everybody is not good at doing de novos. It's a very different skill set to be able to make a de novo work and do it on a consistent basis, and don't have footfalls and don't start opening locations where you're cannibalizing on your existing locations. On the acquisition side, the return on investment is lower than a de novo, but the risk is lower as well because you're buying an established practice with an existing cash flow. Now, the doctor dynamics and the alignment with the doctors plays a more important role in an acquisition, because if you buy something where it's a solo practitioner who has two doctors and one of them leaves shortly after the transaction, you are going to see a dip in your productivity, which in a de novo practice does not exist because you're hiring for that specific practice, and you are able to grow that practice based on your past history.
On the acquisition side, and my intuition is that the pricing kind of answers this question, do you see any pressures on the availability of smaller targets? My intuition is that since the pricing on the smaller ones hasn't moved dramatically, that there's still a pretty healthy supply of those.
Yeah, so you gotta break this down into what the demand and supply dynamics are for the underlying asset, which is the dentist itself, right? So if you look at the last 10 years or so, the growth in the number of dentists has been roughly around 1.5%. The population growth has been slightly overpacing that. But what people are not factoring in is, with the penetration of DSOs in the dental market, the productivity of those dentists has gone up materially relative to where they were 10 years ago. So there is a pretty decent supply-demand balance in this market. Now, it is geographically dispersed, so California, Texas, Washington, Colorado, New York, New Jersey, Pennsylvania are more competitive because people want to live there, dentists want to live there, so you will have a little bit more of a supply-demand imbalance because dentists have more choices. On the flip side, in other geographies, you really don't have that. You really don't have that dynamic going on. Then if you really think about the dentist population and break them down into different age groups, the 55 plus and older dentists are the largest portion of the entire dentist pool, and it is also the fastest growing portion of the entire dentist pool. And those people are going to look for an exit opportunity to monetize what they have built over the last 15, 20 years. And that's why there's a constant supply of targets or smaller targets, and will continue to be for some foreseeable time period. We've also seen a relatively disciplined valuation range for these targets compared to other markets like dermatology and vet, where because there are no de novos and there's a shortage of vets and there's a shortage of derms, the pricing has just gone crazy. Right?
At every level of size.
Yeah, at every level of size. So dental in that respect is more secure because there is ample opportunities for targets and there's ample supply of dentists relative to the productivity that is required in the market.
Maybe turning to some of the kind of subsets within the DSO world. For a while we saw materially lower valuations for Medicaid-oriented businesses for a number of reasons. Some regulatory hiccups on some of the more notable DSOs, questions about kind of stroke of pen risk. How do you see the Medicaid business looking now?
Yeah, I think the market has definitely turned on that. And yes, there was a significant overhang due to some bad actors that happened, call it a decade ago, where there was non-compliance or overtreatment or lack of medical necessity. There are bad actors in every healthcare service business. You can find them in all sorts of different subspecialties. What the investors have, at least in the last 2 to 3 years, what they've realized is, as long as the threshold is definitely higher, especially from a compliance perspective and the audit perspective, and making sure that everything is buttoned up and then there are checks and balances in place in the platform to provide those services, especially if you're treating kids and you're drawing from Medicaid. But they've also realized that there's a true opportunity in that market. If you look at the pediatric market today, it's $37 billion. Large portion of it is commercial. And if you just look at the Medicaid and the CHIP portion of that market, which is, call it roughly a third of the $37 billion, it is still, there's a $10 billion market for Medicaid and CHIP, and only 50% of the kids that are eligible are actually getting dental service on a regular basis. And part of that is because of access to care, and part of that is because of where they are in the socioeconomic stride. They're not going to the dentist on a regular basis. So just if you really think about the white space and pure organic growth opportunity in that market, it's way higher than what you would find in the typical adult general dentistry place.
And we're seeing kind of even more segmentation surrounding some of these markets, like the mobile dentistry that are often serving, whether that's schools or elder care. On some of these kind of more segmented pieces of the market, how would you describe the market for, say, mobile dentistry?
Yeah, so I think mobile dentistry is still in its infancy. There are different kinds of models that have started. There are folks who are focused on providing preventative pediatric care to kids in schools. There are folks who are providing dental services to skilled nursing facilities and assisted living facilities. There are folks who are partnering up with self-funded employers to provide dental services on a turnkey basis to employees of those employers. These are still markets. These are still businesses that are they're smaller in size. They're playing in a pretty large market. They are going to feel some growing pains initially, simply because they are a little bit disruptive in nature, and they are taking market share essentially away from the brick and mortar dentists. Which again, because this is a regulated industry and is regulated on a dental board basis, on a state-by-state basis, they will have to tackle those issues as they're trying to grow the business.
And if history is a guide, the dental boards and other regulatory bodies have been one of the arms that kind of established practitioners have used to defend their turf. We've seen that in a number of states that have put restrictions on who can own DSO or attempted to. So I would expect to see similar presses by the brick and mortar as people try to defend their turf.
Yeah, and I mean, you can take an example of North Carolina, right? It was one of the most, I guess, anti-DSO states that there was out there. But lately,
and then it's coming around.
Yeah, it's coming around. It took some time. They took some precautions. They were cautious about this, the word corporate dentistry, or somebody who's not a clinician managing a dental office or a dental practice. But if you put the right structures in place and the right governance in place and give the dentist the autonomy to do what is right for the patient and demonstrate to those governing bodies or the regulators what care or what outcomes you're delivering, I think it's hard to argue that there's true value being delivered.
And every state can be different. I remember a year ago we were looking at a Medicaid business, and it was moving into a number of different states, and 2 states had laws that were almost identical. But in conversations with the regulators, one of those states was very much of the posture of, hey, whatever you can do that will bring more dentists to our population, we're going to be fully behind. Another jurisdiction that had almost identical laws and regulations to the first one was much more hostile and was putting more significant pressure on what the relationship between the DSO and the practice was going to look like. So it can really vary on a state-by-state basis.
That's correct. Yep.
With respect to kind of integration in the acquisition context, there was a time when it felt like, especially some of the middle market private equity funds were acquiring a platform and then acquiring other smaller practices at such a fast pace and then expecting to be kind of fully paid for that in a pretty near-term sale. That felt like that was creating friction on those buyers. How are you seeing the market evolving as it relates to kind of how buyers view quickly expanding practices that have been expanding through acquisitions of smaller ones?
Yeah, I think the market has definitely shifted on that front. 5, 6, 7 years ago, you could do a roll-up for the sake of roll-up by buying a bunch of practices and putting and stacking them up like bricks and saying, hey, I have a multi-regional or a multi-state DSO and my EBITDA is X and I've got 80.
There's no clinical integration. There's no back office integration.
Exactly, 80, 90 practices. Buyers have become extremely strict and focused on that because what they realize is if you don't have a constant culture across the platform, you're not integrated from a clinical, from an IT, and a back office perspective, and you really and the seller and the management team that is looking over this platform does not have a true value creation plan once they've acquired a practice to improve and enhance that practice, and haven't demonstrated that historically that they have been able to achieve that by pulling various levers. Those practices are being valued, those DSOs are being valued less relative to those who can prove we've done that in the past. We have very standardized, systemized processes around how we acquire, who we acquire, how we integrate, how we add value, and what the timeline for that is. Because in this market, which is a peak market and has been a peak market for 7, 8, 9 years now, dental is no anomaly. Dental valuations have also been very high. People are willing to pay premium multiples for premium assets, but they want to have the conviction that 6 months or 9 months or 12 months after they've invested in this practice at a double-digit teens multiple, they have a view towards diluting that multiple down, both through what they're buying in the existing practice or the existing platform, through organic growth and value-added initiatives that the management team is putting in place and has demonstrated historically, but also through the target pipeline of de novos and acquisitions that they will be executing on.
Yeah, that magic combination of both historical ability to integrate those acquisitions and a robust pipeline is the combination that ultimately gets paid in a sale.
Yep.
Maybe turning a little bit, we're seeing a lot of interest in kind of specialty practices versus general dentistry. What's your overall view of these kind of pure play, whether that's orthodontic or any number of other kind of pure play specialties versus the general, and then let's come back to some of the risks that might be attendant to them as it relates to their referral source.
Yeah, so there's been a fair amount of activity in the pediatric and orthodontic market, some being a combination of two because the pediatric dentist can be a referral source for the orthodontics. Obviously there's a very large orthodontic platform, orthodontic only platform by the name of Smile Doctors, which has been very acquisitive.
A client of mine, thank you.
Yeah, very acquisitive over the last two and a half years, and has grown tremendously, but only focused on, the cash pay or sort of commercial pay orthodontic market only. We've also seen activity in people doing things specifically around endodontics, oral surgery, periodontics as well. I think all these models are a little bit different. So if I were to think about the orthodontic business, I think of that as more of a direct-to-consumer model, right? So yes, there will be a certain percentage of referrals that you will be getting from other general dentists, and as long as you're not trying to get into the general dentistry game, you'll keep getting those referrals. But as we know from Smile Docs and others in the marketplace, they have been able to create a market outreach or consumer outreach program, which has been very successful in generating leads and generating a pipeline for providing these orthodontic services on an ongoing basis to their patients.
And that seems to insulate some of the risk that as the general dentists kind of consolidate into these larger platforms, one of the risks on a specialist, and this is true in other sectors as well, is that if the referrals were coming from general dentistry, if these general dentists are kind of consolidating into these platforms, it's not a very big jump for those large general dentistry platforms to bring some of those specialists in-house themselves and disrupt those referral sources. So would you say the same thing for some of the other sectors like perio or endo that might be more?
Yeah, I mean, I think that's true. So the trick there is if investors are looking at platforms, they want to have geographic diversity and diversity across the referral base. Now, to be honest, it would be hard for me to think that one general dentist is sending a very significant portion of endodontic referrals to a specialist. It has to be diversified given the nature of the service itself. I think oral surgery is a similar one where the direct-to-consumer aspect has worked well. One of the larger platforms in the space is ClearChoice, which focuses on all on four procedures where they're doing full arches, both top and bottom, and their entire focus has been around direct-to-consumer marketing, although their procedures are a lot more expensive and they're targeting a very different size of the population. But we have seen oral surgery practices pop up recently, and investors are looking at investing in those spaces because they see the white space, they see the fragmentation, they see the organic growth opportunity. The other thing that some people are also thinking about or are concerned is some of these are elective procedures, some of these are cosmetic procedures, some of these are not reimbursed by commercial insurance. So what happens in the case of a downturn in the future? Does that harm the business or not? To be honest, we've looked at businesses that have dealt in orthodontia and oral surgery in the past, and if we go back to 2007, 8, 9, we really did not see a dip in those revenue streams or the overall size of the market for those services in those tough economic times.
Sure, and any of those take orthodontic work. Once you started it, you're going to finish it.
Yeah, that's right.
Partway down that path.
That's right.
In a number of sectors, we see pretty elaborate kind of doctor alignment models. We've seen less of that in dental, where the typical model of a percentage of production, which may vary from market to market, but a pure percentage of production type alignment model has been the dominant view, maybe coupled with some ownership. When you're looking and talking with sellers, how do you think about some of those topics, and what are your views on some of the more elaborate kind of profit-sharing type models that you would see in other sectors applied in the dental context?
Yeah, so because of the length of time where consolidation in the dental market has been going on, and the fact that new graduates coming out of dental schools are not really opting to go and start their own practices and are looking to be employees because they want the flexibility and don't want the administrative hassle of running a practice. The market for dentists from a compensation perspective is pretty transparent and it's pretty efficient. So, and that's why it can be competitive in certain geographies because of that reason. We have not seen, so I'll take a couple of different, I'll bifurcate that by growth strategy a little bit. In the case of acquisitions, we have typically seen, there may be an earnout, there may be some deferred compensation attached to the valuation or the purchase price. There could be a rollover, and the rollover can go either ways, either at the holdco level where everybody's in the same equity pool, or profits interest at the PC level, which is where, you're essentially saying we're only going to buy 70% off your practice. You continue to own 30% of your practice. That, again, what has been successful for most consolidators is providing a la carte view on these options, because one size does not fit all. It really depends on the motivation of that dentist. Some guys value equity at the holdco level, whether it's 0.5% off the overall pie, but they can see and they understand the value proposition. Others are more focused on a quarterly dividend or a monthly dividend, saying, hey, I'm now focused not only just on my salary, but also on the bottom line of the EBITDA, and I'm going to get a dividend check every quarter, which I value more. Similarly, on the Denovo side, we've seen strategies where management teams or DSOs have incentivized dentists by saying, hey, you've been an associate dentist in one of our locations, you're a rock star, I want to open a new Denovo, you be the lead doctor, I will give you some equity, PC level equity at that practice. Yeah, in that practice. You don't have to pay me anything today, you don't have to buy in anything today, but over time, as you're producing, you will pay your portion off the cost to start that Denovo, and then you have your equity vested.
Right, and I've noticed that you kind of separated out the idea that folks' economic connection would be at the topco level versus economic connection at the more local practice level, and I've found on the private equity side that it's almost, while different targets may have different views on it, it's often a philosophical view of the private equity fund of just kind of in their view of the world, everyone should be all connected to rowing this boat together, or the contrary view that it'd be better to connect individual practices or individual dentists to economics that they can actually impact. But it feels to me like those distinctions are often kind of core philosophical differences at the private equity fund.
I would agree with you, and I think it kind of exists more at sort of medium-sized platforms, which are still trying to make sure there's some continuity or some level of connectivity across the dentist base, where you're not managing 500 dentists, you're managing 100. But some of the larger practices, larger DSOs, they have begun to move to a more diversified view on...
Which makes a ton of sense, just harder to...
Exactly. It's harder to manage, but I think it results in what long-term alignment on a dentist basis.
Maybe turning the conversation again, the experience in the DSO market for value-based medicine, whether that is capitation contracts with states, has been a little bit mixed, and there's been some winners and losers in those pathways. How do you think of the value-based medicine end of this market?
Yeah, I think it's still pretty early. I think there obviously have been capitation. There's capitation in California, there's capitation in Oregon, there's capitation in New York, through different payers who are providing a PMPM rate for providing services to the constituents or the enrollees. I think if medicine is behind business services by 10 years, dental is further behind from a technology and a data collection perspective. So till you're actually able to find the right pathway for a patient based on, data collected and managed and reviewed and analyzed, it's going to be hard to implement value-based care. We're seeing value-based, the forefront of value-based care today is around primary care, and the second largest is probably around orthopedics. And the reason is because they actually have the volume to provide the data, and they're really, really big, large markets. It will happen, but I think some of it needs to be a modification of the dental as not just looking at teeth, but overall management of oral health, that combined with your overall clinical health or medical health of that individual. So we are seeing some aspects of that, for example, in Aspen Dental, they're
moving into urgent care.
They're moving into urgent care. There's Hero DVO, which is another platform which is doing vision and dental together. So I think models like those are innovative. They really provide value. It will take time for VBC for really to be implemented in the dental space, but I think the first step needs to be a real connection between the medical aspect and the oral health aspect, and really treating that individual as one holistic person, as opposed to saying there's no. A dentist can, a mouth can tell you a lot more about a lot of things about that person's health, and if you're not connecting with the primary care physician post that, you're losing that opportunity to provide better care and lower costs in the system.
And poor dental care can very much lead to more pronounced other healthcare episodes, to be sure.
Absolutely.
But I agree that the dental space is further behind in that sequence. I think with that, we'll start to wrap this up. KG, it's been great for you to spend some time with us. I think we'd say to all the folks listening that if you are looking at either buying or selling a dental practice, KG, the first person I'd send you to chat with. KG, why don't you give your phone number for the folks?
Sure, it's 312-456-4758.
And then if you're looking to buy something or sell something, you also need a lawyer, so you should call me. 312-849-8272. Thank you, everyone, for joining us, and with that, we'll call it a wrap.
Thanks, Jeff.